Hi everyone, Assalamu alaikum wa rahmatullahi wa barakatuh. Inshallah, before we start, I want all of you to confirm that my cam is clear and my voice is clear. Okay? Can I get a confirmation, please? Hi Manar, how are you? Hi Suhaib, I can see you all. Okay, great, great. So let's say Bismillah ar-Rahman ar-Rahim and start our second webinar, our masterclass in startup finance from ExecuFinity. Bismillah ar-Rahman ar-Rahim. Can you see the presentation? Yep. So before we start, I want you to head to the right of your screen and participate in our poll question. We have two poll questions. First one, which best describe you right now? A founder, finance professional, manager, executive, or student, early career. Okay, and the second one, which free course did you finish with ExecuFinity? So I'll give you 2 minutes to start right now. Mashallah, we have almost 1900, 1900 participants right now live. So go ahead, I'll give you 1 minute or 2 minutes to pick your selection and give me a thumb up. Don't write it, Rasha. Just pick your selection in the poll question to the right of your screen. And please, before we start, you will see the Q&A part with a question mark simple. Please, whenever you have a question, leave it here. Don't place it in the chat, okay? Just leave it here and I'll take a look at it at the end of the masterclass. Okay, Khalid, you should have started. So let's say Bismillah ar-Rahman ar-Rahim and start our second masterclass with ExecuFinity. So 90% of startups fail. 90% of startups fail. And that number gets quoted at conferences. And it shows up in articles. People not add it and move on, but nobody stops to ask the real question, which is not why startup fails. The real question is, could those failures have been predicted? Could those failures have been predicted or not? And for me, the answer is yes. Most of them could. And it's not because the founders were not talented, not because the market was not there, but because the financial architectures was broken before the company ever ran out of money. And the decision that killed those companies were made months, and sometimes years before the cash hit zero. That's what we're here to talk about today. For the next 2 hours, going to be long today. For the next 2 hours, we're not doing an accounting course. We are not going to sit here and memorize formulas for the sake of memorizing formulas. No. What we're going to do is to build a financial operating system in your head, in your mind, one that you can use tomorrow morning in any company at any stage. For all of you who don't know me, my name is Dr. Tamer Alsayed, and I've spent years, over 24 years, as a CFO and strategic advisor managing portfolios that cross $300 million. And I've sat in the boardroom when the cash was running out. I've also sat in the boardroom when we had more runway than we knew what to do with. And I can tell you, the difference between those two moments was always made months before you could see it on a dashboard. So let's get to work. Our masterclass roadmap for tonight. Here, how is the next 2 hours are going to run. And I want you to understand not just what we're covering, but why the order matters. We start with the core problem, 10 minutes to understand what's actually killing startups. Because if you don't understand the disease, the medicine won't mean anything to you. Then we go to startup DNA and capital, and that's the core. That's the core of tonight masterclass. 20 minutes to understand what a startup actually is financially, because most founders are running the wrong financial playbook from day one. Then we get into financial fundamentals with a real case study. We have many tonight. A company called Fast, which raised over $100 million and shut down in under 3 years. We're going to do the math together. And I need all of you, please, to participate in the quizzes. Okay? After that, we read financial statements through the lens of an inspector. A company that never raised a dollar of venture capital and sold for 12 billion. Then we go into valuation and equity with WeWork as our cautionary tale. And we close with the path to profitability, which is the framework that determines whether your startup survives or become a statistic. And here is the question I want you to hold in your head for this entire session. Even write it down right now. Am I currently operating a product, or am I architecting a financial engine? Architecting a financial engine. Keep it in your head. That distinction is everything. And by the time we're done today, you will know exactly which one you are doing, which one you're managing. So what's our goal today? And let me be direct with all of you about it. Objective one, you will master unit economics. CAC, CAC, LTV, payback period, and I'll tell you all about it. Okay? It's not as accounting terms, as a survival signals. As a survival signals. You will know what these numbers tell you about whether your business model actually works or not. Number two, you will understand how venture capital or VCs actually makes decisions. The math behind the VC fund is not intuitive. And most founders don't understand it until they are already in a negotiation. We're going to fix that today. Objective number three, you'll be able to architect a capitalization strategy. That means knowing when to raise, how much to raise, what to give away, and how to protect yourself from dilution that quietly bleeds your equity to zero. Okay? And objective number four, you will implement what I call the default alive framework. The default alive framework. This is the single most important operational concept in startup finance. By the end of today, you will know exactly whether your company is default alive or default dead. Keep that in your head. Default alive or default dead. And what to do about it either way. So again, we're not going to discuss textbook terms, terminologies. No, these are the exact frameworks I've used when sitting across the table from board who wants answers. And the clock is ticking. Let's start with the problem. So before we can solve anything, we need to be honest about what we're dealing with. Section one is 10 minutes, and this might be the most important 10 minutes of the session, because what I'm about to tell you really is going to change how you look at every business decision you make. So I want you to look at the chart. Take a screenshot. You're gonna need it. Trust me. In our quiz, you're gonna need it. Take a screenshot. Look at the chart. What you're seeing in the entire startup life cycle mapped again is two forces: risk and capital. Risk and capital. And here is the insight I want you to take from this. These two forces move in opposite directions. In opposite direction. As a company matures, as it moves from pre-seed to seed to Series A or Series B and beyond, risk goes down. As we move from series to another, the risk goes down. And the business model becomes clearer, becomes more clear. Your customers are real. You have customer base. And risk decreases. Okay? But capital requirements go in the other direction. They go up. They go up. They go up exponentially. Big time. So the paradox every founder faces, the stage where you have the least money is also the stage where you are taking the most risk. Again, the stage where you have the least money, the least amount of money, is also the stage where you're taking the most risk as a founder. And I'll tell you why. And valuation, which is what we'll cover in section 5, is the bridge between those two forces. What are the forces? The risk and capital. Okay? The risk and capital. It's how investors price the gap between current risk and future potential. Understanding this map, take a screenshot. I keep repeating myself. Take a screenshot. So if you understand this map, you will change everything. It tells you which investor to approach, to reach out, and what story the numbers need to tell every stage. Okay? So which stage are you at right now? If we discuss today is going to land differently on where you sit on this map. So I'm gonna open one more poll question for you. You can see it on your right side, which is the Runway calculator. Okay? And I'll tell you why right now. So we are going to do something practical before we even get to the theory. This is your Runway calculator. And I'm going to ask you to fill it in right now before we head towards the next slide. Okay? From memory, if you can, because what you're about to calculate is the most important number in your business, the cash runway. So step one, total cash balance right now, write it down. What's your total cash balance right now? Not revenue, total cash balance, not revenue, not valuation, cash in the bank. Step number 2, what are your monthly expenses? Everything, payroll, rent, software subscription, everything that goes out the door every month, that is your gross burn. Step number 3, what's your monthly revenue? The actual cash coming in. If you have gross burn minus monthly revenue, that's your net burn. So gross burn minus, that's how much cash you are actually losing every single month. Cash balance divided by the number you get is your runway, measured in months. So take some time. I'll give you 1 minute to finish it. From the memory. If you're a founder, if you're an executive, if you are a CFO, if a finance professional, even if you are a fresh grad, you work for a company, you know how much cash do you have in the bank? So give me a vote here. So that number is your survival timeline. It is change the way 45% voted for under 6 months and 50% 6 months. So the minimum viable target, take it as a rule. The minimum viable target is 12 months, 1 year. 12 months of runway time before you require outside capital. Okay? The minimum viable is 12 months of runway at all time before you require additional capital. And here is the rule I want. And if my runway exceeds 80, you are not going to hire anyone. 50% of the new hiring salary. It's not suggestion, by the way. That's commitment. Commitment on company survival. Is my voice breaking still? Hello? Can you see me now? Thank you. I'll put the slide again. Can you see me now and hear me or not? Can you see me clearly? Okay. Okay. So again, 90%. 90%. That's the failure rate of startups. And when you hear that number, your brain wants to organize around things like bad timing, wrong market, wrong team, wrong hiring. Those are execution errors. We can see those coming. But 29% of failures, nearly a third, happen for one specific reason. They run out of cash. And here is the part that should keep up at night. Most of those cash failures were predetermined. They were not surprises. Trust me, they were not surprises. The company did not run out of cash on a Tuesday and the founder found out on Wednesday. No. The trajectory was visible in the financial months, sometimes a year or more before the bank account hit zero. I've seen this pattern firsthand. A founder is optimistic about deals that's almost closed, and a CFO has pushed the hard conversion to next quarter. And a board is focused on the top line numbers and nobody is looking at net burn. And then one day, they are out of cash and everyone acts shocked. The question here from me to all of you, okay, and even you may ask yourself, if someone handed you your financial statements right now, the real ones, not the investor pitch deck, how many months of runway would show? Most founders don't know the answer to that question precisely, and that's the problem. Because financial literacy at its core is not about accounting, it's about survival strategy. And survival requires knowing the truth about your numbers, even when the truth is uncomfortable. And by the way, I was just prepping you before even we start module 1 or section 1. Let's spend some time here around the action plan timeline. Before we move to section 2, I want to give you the operating cadence. In the next 7 days, keep that in your mind. The next 7 days, not next month, not next quarter. In the next 7 days, audit your cash, your gross burn, and your runway. Build a simple dashboard if you don't have one. This is non-negotiable. And in the next 30 days, validate your unit economics on your narrowest, the smallest part, most profitable customer segment. And freeze spending until your LTV to CAC ratio, and I will tell you what is that, hits 3 to 1. We will define exactly what time means in a moment. By day 60, run a scenario plan. Build 3 versions of your financial future: base case, best case, and worst case. And define the hiring gates that are triggered by each scenario. By day 90, you are either executing a survival plan or a scale plan. And you will know which one it is. And you will have a board update, okay, that will keep everyone informed in real numbers and not narrative. Okay, so let's start Startup DNA Capital. Can I just confirm if you all see my cam or not? Okay, that's good. I want you to look at the KPIs benchmark. Okay, take a look at it. Take a screenshot. We're gonna need it later. We're gonna need it later. Okay. And before we answer that question, I want to take your attention. Give me your attention. Focus with me, please. I want to put the full metrics framework in front of you. That is the full metric in front of you because this is the language we're going to speak for the rest of the session. Three categories of metrics: core survival, growth engine, and operating what? Operating what? Write it in the chat box. We have three categories: core survivals, growth engine, and operating health. So, operating health. Exactly. Thank you. Thank you, Ahmed. In the survival category, cash balance, gross burn, net burn, and runway, these are the vital signs. These are your vitals. Okay. Cash balance is the oxygen. Gross burn tells you your absolute overhead. Net burn tells you the true rate at which you are consuming your survival timeline. And runway is the hard deadline. Runway is what? The hard deadline. In the growth engine, customer acquisition cost, CAC, tells you how efficient your go-to market machine is. Again, CAC or CAC or customer acquisition cost tells you how efficient your go-to market machine is. And lifetime value, LTV, tells you the total profit ceiling a single customer represents. So again, the customer acquisition cost tells you how efficient your go-to-market machine is, and LTV, lifetime value, tells you the total profit ceiling a single customer represents. So the LTV to CAC ratio validates whether your business model actually works or not. Speaking of the payback period, it tells you how long your working capital is locked up before a customer becomes profitable. And gross margin tells you whether scale creates value or just creates more cost. And in the operating health bucket, MRR and ARR. So I need someone to tell me what's MRR and ARR in the chat box, please. Is my voice gone again? I don't know what's going on today. Can you all hear me? Yes. Okay, great. Amazing. Okay, perfect. I actually need to apologize for today's technical issues. I don't know what's going on with the internet. But anyway, you're here, I'm here, and we're doing this, inshallah. I would like just to allow me 1 minute. I will log out and log in again because I still cannot see my own camera. Okay, just give me a minute and stay online, please. Yes, correct. The issue is that I cannot see myself, so I believe it's an issue with me, not with you. I'll pull up the slide again. If you have any question, Ahmed, add it to the Q&A part, please. So moving ahead with the LTV, okay? The unit economics flywheel. I call it the unit economics flywheel. So I want to show you something. My screen is freezed. The cam or the screen itself. Can you hear me quite good or not? You guys are confusing me. Am I visible or not? Okay, thank you. Let's carry on and please stop writing right now. Okay. So unit economics flywheel, please. I want to show you something that VCs call the flywheel, and I want to show you why it is the most important concept in startup growth strategy. And the idea is this. You spend money to acquire a customer. That's your customer acquisition cost. The customer activates. Okay, they start using your product and generating revenue. That revenue multiplied by your gross margin drives your ARPU, your average revenue per user. High retention keeps that customer around longer, which increases their lifetime value. So when the payback period is short, meaning you recover your CAC quickly, you have cash available to reinvest. So when the payback period is short, meaning you recover your CAC quickly and you have cash available to reinvest. And when you reinvest intelligently, two things happen simultaneously. LTV goes up because better product, better retention, higher margin, and CAC goes down. Customer acquisition cost goes down because brand equity compounds. Because referrals come in, because your targeting gets sharper and you're targeting good customers. And when LTV is going up and CAC is going down at the same time, that's the flywheel. That's the compounding effect. That's the compounding machine that every venture capital investor is looking for. And the goal isn't just to acquire customers. The goal is to build a machine where every customer funds the acquisition of the next customer. Every customer funds the acquisition of the next customer through LTV and payback efficiently. And that's the difference between a company that grows and a company that scales. Growth means adding customers. Scales means every customer you add makes the next one cheaper and more profitable. We'll come back to this. When we dissect fast. A company that had hundreds of millions of dollars, 400 employees, and never built this flywheel, not even close. Before we continue, am I clear again? I have to confirm this. Can you all hear and see me, please? Okay, alhamdulillah. So, unit economics calculator. And if you have a pen, a piece of paper, write down. So second worksheet, let's do the math together. Your CAC, okay? Let's do the math. Your customer acquisition cost. Take your total sales and marketing spend for a period. You need to memorize this formula. Take your total sales and marketing spend, total sales and marketing for a period, let's say a month, a quarter, by yearly, or last quarter, for example, and divide it by the number of new customers you acquired in the same period. So total sales and marketing in a period, what divided by the number of new customers you acquired in that same period. That's your cost to acquire one customer. Your L2V, take your average revenue per user, multiply it by your gross margin percentage. Then multiply that by the average lifespan of a customer in months. That's the total profit one customer generates over their relationship with you. And third, your payback period. Take your customer acquisition cost and divide it by your monthly ARPU multiplied by your gross margin percentage. The result tells you how many months it takes before a customer pays back what you spent to acquire them. Okay? Now look at your LTV CAC ratio. If it's less than 1 to 1, you are destroying value with every single sale. So if it's less than 1 to 1, you're destroying value with every single sale. Stop, do not scale. Okay, you're running a machine that produces negative returns. Scaling it will only accelerate the damage. So if it's between 1 to 1 and 3 to 1, you are in the fixed zone. The unit economics are not yet sustainable. You need to either reduce your CAC, increase your price, improve your retention, or some combination of all three. Okay? Reduce your CAC, increase your price, improve retention rate, or combination of all of them. If it's above 3 to 1, now you can pour fuel on the fire. Okay? Now scaling makes mathematical sense. Now growth compounds. So I want you to know your number before you leave this room. Not approximately, but precisely. So, while I believe you have an issue, I believe you do have an issue. Thank you. So let's continue the startup finance framework. The startup finance framework. And here is the macro framework. And this is something I want you to remember for the rest of your career. Trust me. Okay? For the rest of your career. Financial success in a startup is not accidental. It follows a sequence. It follows what? A sequence. Unit economics fuel survival. Survival enables capital strategy. Capital strategy drives valuation, and valuation determines dilution. You see the circle? You see the sequence? Unit economics fuel survival. Survival enables capital strategy. And capital strategy drives valuation, and valuation determines your dilution. And all of it leads to a path of profitability, which is executed through a consistent cadence of dashboards and reviews. So if you skip steps, if you try to run a capital strategy before your unit economics are proven, or if you pursue valuation before you have established survival metrics, you accumulate what I call architectural debt, not technical debt, financial architectural debt. Am I freezing again? So I believe whatever you have. Thank you, Khalid. Thank you, Khalid. So, guys, whoever has a network issue, please log out and log in again. Okay, like 90% of the audience are showing a thumb up. So let's continue, please, with no disturbance, please. So here's the financial reference sheet. That's your playbook. That's your playbook. So let's crystallize the formulas you will use, not just today, but every week. So net burn is gross burn minus revenue. Memorize this. Net burn is what? Gross burn minus revenue. That's the real cash consumption rate. Runway is the cash balance divided by net burn, your survival countdown. The CAC, sales and marketing spend divided by new customers. Take a screenshot of this slide, please. LTV is what? ARPU times gross margin times customer lifespan. LTV to CAC ratio, which is LTV divided by CAC. So I'm going to open one more, the current cash runway. Think about it again. We'll not spend a lot of time over here. We still have a lot to cover. So, section number 2, startup DNA and capital. It's like the fuel for growth. Okay, I see now two more are saying connection is not stable. I'll try to sign out and sign in. Stay online, please. I'll come back. Do you all see me now? Do you all see me now? It's fine, you're enjoying. Thank you so much. Okay. So please, no more disturbance. If there is an internet issue, it means it's your issue, not mine. Thank you. While you're the only one complaining, please, it's log out and log in again, please. Thank you. So, section number 2. Here is the definition I want you to look at and also to lock in. A startup is not a small version of a large company. A startup is not a small version of a large company. And that sounds obvious, but the reason most startups manage money the wrong way is because they apply the financial logic of a traditional business to an entity that operates by completely different rules. Okay? A startup is a temporary organization designed to search for a repeatable and scalable business model. Okay? So look at this. Look at this. So temporary searching, those two words, temporary and searching, those two words are carrying enormous weight. Why startup is temporary? Because the goal is not to stay a startup forever. The goal is to find a business model and then become something different. A growing company. Okay? An established business or an acquisition target. Searching, the second word, because in the early stages, you do not know the answer. You don't know the answer. Nobody has the answer. You're running experiments. And that means traditional financial metrics like immediate net profit. They are often not just irrelevant, they are actively misleading. So let me give you the 5 characteristics that makes a startup financially unique. Okay? Innovation driven by creating a net new value, not competing on price. Okay? Exponential scalability, designed to grow. Something designed to grow. And to grow what? Revenue vastly faster than marginal cost. High uncertainty. All startups are uncertain. The business model is still unknown. And then the talent density, relying on highly specialized, agile teams. And then it's equity funded, financed by venture capital to bridge the gap between immediate cost and delayed revenue. The last one is critical. Costs are immediate, revenue is delayed. Think about it again. Costs are immediate, revenue is delayed. Capital is what bridges that gap. You spend money on cost, but no revenue to collect. So capital will bridge the gap. If you don't understand that structure, you will make financial decisions as if the gap doesn't exist, but it does. And trust me, that gap will kill you. So looking at the capital life cycle, this is literally the capital life cycle. Okay? Because this is the financial map, every founder and CFO of a startup, I was a CFO of a startup, and every founder needs to internalize. So if you start with the bootstrap and pre-seed, $0 to $500,000, it's like $500,000 and less. Your job at this stage is to validate the idea, customer discovery, market sizing. Does the problem you think you are solving actually exist? And do the people care enough to pay for the solution you have created or not? Then you have the seed, 500,000 to 3 million. So the bootstrap and pre-seed is 500,000 and less. The seed is 500 to 3 million. You build your MVP. What is MVP? Tell me in the chat box, what's MVP? Write it in the chat box. What's MVP? I want to hear it from you. Exactly, Saeed. Thank you. Thank you. Minimum viable product. Minimum viable product. So you build. Thank you, Khaled. Thank you, Khaled. So minimum viable product. You build it. You want to acquire early users. Early users. Establish your core survival metrics. By the end of this stage, seed stage, you need evidence that your product creates real value. You see the difference between bootstrap, pre-seed, and seed? Okay? So you go up one more step in the ladder, which is Series A. Now you're talking big numbers, $3 to $10 million. So we started with half a million or less, then seed half a million up to 3 million, and then Series A, which is $3 to $10 million. This is where you scale a repeatable go-to-market strategy, not experiment anymore. You scale one that's already working. Series A is the fuel, not discovery money. This is the fuel when you scale. And Series B and beyond, C or D, it doesn't matter. It's 10 million plus, 10 million plus, which is market expansion, category leadership, geographical growth, okay? Product suite expansion, product suite expansion. Notice what happened to risk as you move along that line. Okay, because risk always comes along with the capital. Extreme risk at pre-seed, okay, high risk at seed, moderate risk at Series A, lower risk at Series B and beyond. And notice what happens to capital requirements. They grow big time. So the value of this, and I'll tell you what is the value of this, that treasures gap between seed and Series A. I want you to write this word down, the value of this, Awadi al-Maut, as we call it, okay? That gap between seed and Series A. Why we call it value of this? Because this is where most startups die, between seed and Series A. Because founders raise seed money, assume it gives them 18 months of runway. They hire aggressively before proving the product market fit, and they run out of cash before they hit the metrics that would unlock Series A. It's like the antidote is simple to say and hard to execute. Prove product market fit before you pour fuel on the fire. So the value of this, which is the stage between what seed and Series A. So again, the value of this diagram is the trap sequence goes like this. And it's painful to watch, by the way, because it's entirely predictable. You can't predict it. Step one, founders raise $1.5 million in seed capital. They feel good. I'm good. I raised, let's say, $1.5 million. And I feel funded. I feel like the hard part is done. No, you just started. Step two, they spend on hiring and overhead before they even have a proven product market fit. They have built a team that requires $200,000 a month just to keep the lights on. Step three, the metrics don't come as fast as projected. Revenue is slower than the model said it would be. The Series A investors want to see numbers that are not there yet, and the cash is gone already. The trap is not, I don't want to call it, but anyway, the trap is not incompetence. The trap is assumption. In your assumption, the assumption that growth will follow funding. No, growth will not follow funding. But growth is not a function of headcount. Okay, focus with me. Growth, they assume growth will follow funding, but growth is not a function of headcount. Growth is a function of product market fit. You can grow only if you have a product that meets the market need. And product market fit is earned through iteration, not through hiring. So we have quiz number 1. Look at the question again, and I will show you quiz number 1 right now. From what we have discussed so far, okay, which characteristics most fundamentally distinguish a startup financial model from traditional small business? What's the difference between a startup and traditional business? Option A, the requirement for office space. Okay. Option B, the reliance on debt financing. Option C, what? The requirement for scalability. And option D is the need for a marketing budget. I want to see some answers here. I'll give you 1 minute. Again, what is the difference between a startup financial model and a business that's running? Think before you answer. So far, I see less wrong answers, which is a good sign. We have 20 seconds remains. So, if you haven't answered till now, stop it. I will tell you what is the correct answer. And the correct answer is C, scalability. Exactly, scalability. You don't have to write it here. Please write it in the poll question. So venture capital mass is built on something called the power law. Okay. VC mass is built on something called the power law. A VC fund invests in 20 companies. They expect 16 of them to return zero. They need the remaining 4 to return enough to pay for everything, or maybe go unicorn, including the losses, by the way, and then deliver their fund return on top of that. And that requires what? Scalability. Not linear, not good ones, big ones. So let's say software and technology enabled businesses are the only model that can realistically achieve this, because they can serve millions of users globally with near zero margin cost. Every additional customer adds revenue, but almost no additional cost. That is the fundamental financial distinction. A traditional small business grows linearly. A venture-backed startup is designed to grow big time, exponentially. And managing those two different trajectories requires completely different financial framework. That's why what works for a traditional business can kill a startup. And why what keeps a startup alive would confuse a traditional banker. And now is the time for our first fundamental case study, a company called Fast and Section 3. We're going into financial fundamentals, and we're going to learn them through the story of a company that had every advantage in the world and still failed completely. Fast, $124 million. Keep that number in your mind, $124 million. 400 employees. A valuation north of $500 million, and then nothing. So let's understand why, starting with a concept that trips up almost every founder. And I love this. I love this. I call it the illusion of profitability. The illusion of profitability. And here is something that gets companies killed. And it's hiding inside the most basic accounting concept you learned in schools. Accrual accounting. Accrual accounting allows a company to record revenue when it's earned, not when the cash actually arrives. It allows a company to record expenses when they are incurred, not when the check is written or collected. And the result is your income statement can show a profit, a beautiful, clean, positive profit, and at the same time, your bank account is negative. You're literally you're literally running out of cash while your accountant tells you you are profitable. This is not a theoretical edge case. This happens. And it happens in early stage companies where customers' payments are delayed. It happens when large enterprise clients take 90 days to pay invoices. Startups do not die from lack of accounting profits, they die from lack of cash. We all know cash is a king. This is why the cash flow statement, not the income statement. The cash flow statement is the most important financial document for any startup leader because it tells you the actual movement of money in and out of the bank, not accrual adjustment, not amortization schedules, just how much cash came in, how much went out, and what's left. Again, we go back to survival metrics: gross burn, net burn, and cash runway. So let's make this operational. Gross burn is the total cash going out the door every month. Hold on, Mahmoud, please. Hold on. Okay. So the total cash going out the door every month before any revenue offset. Payroll, rent, cloud infrastructure, subscription, license, everything. In the example on your slide, $250,000 a month. Okay, all operating expenses, 250K a month. The net burn, gross burn minus monthly revenue, that's the real cash depletion rate. In the example, 250,000 minus 100,000 in revenue equals 150,000 in net burn per month. So our net burn is 150K per month. That's the actual pace of survival. And then the cash runway, cash balance divided by net burn. We have the cash balance divided by the net burn. In the example, 1.8 million divided by 150,000 equals exactly 12 months. Now look at the benchmark. It's less than 6 months, right? The target benchmark, which is critical danger zone. You are not strategizing right now. You are reacting. 12 months is the minimum viable threshold, the minimum viable caution. That's your safety net. 18 to 24 months is where you want to be. You always target 18 to 24 months because fundraising takes longer than founders expect. It takes, trust me, I've been there. It takes a very long nights and months. And you need time to be selective rather than desperate. Again, desperation creates dilution. So there is a direct relationship between the length of your runway and the quality of your investor conversations. When you have 6 months of runway, you negotiate from fear. You negotiate from fear. You're scared to lose the investor. When you have 24 months of runway, you negotiate from strength. You have the leverage. So every financial decision you make, every hire, every vendor, every marketing campaign should be evaluated through one filter first. One filter. What does this do to my runway? What effect it will have on my runway? Am I clear? So now, growth metrics framework. Let's go deeper into the unit economics. And it will prove whether a business model actually works or not. So customer acquisition cost, $100,000 spent on sales and marketing, divided by 100 new customers. Okay, so equals $1,000 per customer. So the customer acquisition cost is what? $1,000 per customer. LTV, which is the lifetime value, $100 per month per user, which is multiplied by 80% gross margin, multiplied by 40 months of average customer life span, equals what? $3,200 per user. So the ratio 3,200 divided by 1,000 equals 3.2 to 1. You see it here in red, 3.2 to 1. I wanna pause here. That 3.2 to 1 ratio is right on the edge of the benchmark. It says what? It says that this business model is sustainable. You can scale it, but there is no room for error. There is no room for error. If CAC goes up by, let's say, 20%, which it will if you move into new markets, or if gross margin drops, which it might if you hire more support staff, the ratio falls below 3 to 1, and the scaling logic breaks down. So the ratio does not just tell you whether to scale, it tells you where to focus. If the ratio is broken by high CAC, your go-to-market is inefficient. So fix targeting, fix conversion, and fix the funnel. If the ratio is broken by low LTV, your product is not sticky enough. You need to fix retention, you need to fix pricing, you need to fix expansion revenue. And the math here tells you where to look. You just have to be willing to look. So, the case study. The company called Fast, founded in 2019. The idea was elegant. A one-click checkout button for e-commerce business. One click checkout button for an e-commerce business. Think of it as universal Amazon one click, but for any website in the world. Stripe invested, by the way. We all know Stripe. Stripe invested. Index Ventures invested. Big names, huh? Big names. The company raised 124.5 million and reached a valuation above 500 million. They had 400 employees, partnerships, a NASCAR sponsorship. Come on, which should maybe have been a signal, but we will come back to that. Okay. The story Fast tells is this: we are building the checkout infrastructure for the entire internet. And the story the financials told was something entirely different. And this is the lesson I want you to carry forward. The narrative in your investor deck and the reality in your financial statements will always converge. And the only, let's say, question is when and whether you are the one forcing the conversion or the market is forcing it for you. Now we get into more technical. Okay. I will take a look at the Fast financial architecture. Let's do the math. So the company we're talking about right now, Fast, charged merchants approximately 2.9% plus 30 cents per transaction. 2.9% plus 30 cents per transaction. And that was their revenue model. That's it. That was the revenue model. But here is the problem. They process payments through Stripe. And Stripe charged them a processing fee. You see the business model now? Okay. After paying Stripe, the gross margin on each transaction was essentially microscopic. A few transactions of a percent. A few fractions, small fraction of a percent. So with 400 employees, their gross burn was estimated at approximately $10 million per month. 400 employees, gross burn was estimated at approximately $10 million per month, annualized. That's $120 million per year being consumed. Imagine it. That's a very big number. And the revenue in all of 2021, Fast generated approximately $600,000 in total revenue. $600,000 in revenue against $120 million in annual expenses. You do the math. That is a 200 times discrepancies. For every $1 they earned, they spent 200. Think about it this way, by the way. For every $1 they earn, they spent 200. This is not a growth company with a high burn rate temporarily outpacing revenue. No, this is a business where the unit economics were structured fundamentally broken. And the worst part is that what really, yes, exactly, Tamer, fastest burn. And the worst part is that should terrify you, is that $124 million of investor capital could not fix it. Because you cannot solve a structural margin problem with more capital. Okay? Again, gross will not follow capital. Capital will follow the gross. Capital accelerates a business model. Capital accelerates the business model, but it cannot repair a broken one. It cannot repair a broken one. So, the LTV to CAC ratio at Fast was approximately 0.1 to 1. So for every dollar of customer lifetime, value generated, they spent $10 to create it. Okay? They spent tens of thousands of dollars to acquire each merchant. High pressure sales teams, events, sponsorships, the NASCAR deal sponsorship I mentioned before. And because the gross margin per transaction was effectively zero, the lifetime value of each merchant was almost nothing. High CAC plus near zero LTV equals an inverted ratio. And an inverted ratio means every customer you add destroys value. It goes back in value, it doesn't move forward. The more customers you acquire, the faster you die. That's the tricky part. The more customers you acquire, the faster you die. And no capital can fix this. No venture capital company can fix a negative unit economics. So because more capital with negative unit economics is not a solution. It's an acceleration of failure. Because the company Fast raised more money, they hired more people, 400, they spent more on marketing, and all of it made the problem even worse. Faster. So in April 22, the company shut down entirely. They started 2019, if you remember. And in 2022, the company shut down entirely. They laid off all 400 employees. The investors lost everything. Zero. And the lesson is not that Fast had a bad team. No. It's that they scaled before proving unit. I want to hear it. Say it. Don't write it. The company failed not because they had a bad team, but they scaled before proving unit economics. Again, unit economics. They poured fuel, means they raised capital on a fire that was not burning. And $124 million of fuel on an unlit fire just creates an expensive mess, an expensive loss. And what is the lesson here? You must prove unit economics before scaling. That's your quote. I want all of you to write it on LinkedIn tomorrow. You must prove unit economics before scaling. You must prove your unit economics before scaling. So it's the time for our interactive pool number 2. And due to time constraints, I will give you like 30 seconds to start. You have a working MVP, minimum viable product, and you have 10 paying customers, and you need $500,000 to hire a sales team. Who do you pitch to? Okay. What type of investor are you going after? Option A, tier VC like Sequoia, that's one of the big names. Option B, local angel syndicates. Option C, commercial bank loan. Option D, private equity buyout firm. Think about the capital life cycle we discussed. What stage are you at? You have a working MVP and 10 paying customers. What stage does each of those investors actually fund? And if you had a solution in mind, I want you to think, why not the others? Why not the other option were selected? So, a lot of you picked number 1, and the majority picked number 2, which is the local angel syndicates, which is the correct answer, by the way, because local syndicates invest at Series A or later. Okay. A commercial bank wants collateral and cash flow history, which you don't have right now. And a private equity firm buys mature businesses. Angel investors at the idea to early traction stage, you have only 10 customers, an MVP, which is exactly what you should look after. So the correct answer was B. One more quiz. And it's visible right now to all of you. And I want you to calculate the runway calculation. Pick the correct answer. A startup has $2 million in the bank. Monthly expenses are $300,000. Monthly revenue is $100,000. What is their runway? 6.6 months, 10 months, 20 months, or infinite? That's why I told you take a screenshot. I want to know who picked 20 months and who picked infinite. Come on, guys. Come on. So, all of you, the answer is B, 10 months. Again, step 1, net burn. Okay. Gross burn of 300,000 minus revenue. Gross burn of 300,000 minus revenue. Okay. Equals what? Equals 200,000 in net burn per month. So the cash balance of 2 million divided by the net burn of 200,000 equals 10 months. Here is the answer to all of you. So we have our second case study, Mailchimp. Mailchimp. We're going to go through 3 financial statements, 1 extraordinary case study. The story of Mailchimp is almost the perfect mirror image of Fast. You remember Fast, how they failed quickly? This is the opposite of Fast. While the same industry, software, completely different financial architecture, and the outcomes could not be more different. And let's start. So we have our 3 pillars of truth. Our 3 pillars of truth. Every business tells its financial story through 3 documents, and each one answers a different question. Income statement, this is your business model on paper. It shows whether revenue exceeds expenses over a defined period or not. So, and also it answers, does this business makes money? In theory. I say in theory because, as we discussed, the income statement operates on accrual accounting, which means it can show profit while your bank account burns or even negative. Pillar number 2, the balance sheet. This is the snapshot of financial health at a single point in time. Asset on one side, cash, account receivable, equipment, intellectual property, IPs. Liabilities on the other side, the vendor, payable, debt, convertible notes, deferred revenue. And the difference is equity. That's the plug. The difference is equity. How you funded the business. What belongs to founder and investors? So the key question, what do we own? The asset. What do we owe? Liabilities. And who actually owns us? The founders and investors. And then my favorite statement, the cash flow statement. This is the survival reality. It's like the moment of truth. It strips away every non-cash accounting artifact and shows you exactly how much real money moved in and out of the bank in a given period. So you should ask yourself, will we run out of money next month or not? For a startup, the hierarchy is not debatable. Cash flow first, always. I don't care about P&L, I don't care about balance sheet, I care about the cash flow for startup. Am I clear? Okay. I know we have tonight a lot of finance people, but this one is for the founders, for the business owners, for non-finance people. Reading the balance sheet. The accounting equation. Take a screenshot. The accounting equation is this: asset equal liabilities plus equity. Assets are what you own. What you own. Cash, which is, I call the oxygen. AR, account receivable, what customers owe you but haven't paid yet, the outstanding collection. Inventory and equipment and IP. Liabilities are what you owe. Vendor payables, debt and bank loans, convertible notes. It's an important instrument in early stage companies. Deferred revenue, which is money you have received from customers for services you haven't yet delivered. That's the accrual accounting. And equity is the residual, the difference, the gap, the plug, whatever you call it, which is asset minus liabilities. And let's say it represents the ownership stake. Founders shares, investors shares, and the option pool reserved for employees if they have employee shares. And here is what I call the founder's lens. The thing that matters most when you look at a balance sheet. Don't get distracted by paper, okay, by reports, by name, by titles. A startup with $10 million of IP, intellectual property, on its balance sheet, but $200,000 in cash has one real problem. It's going to run out of oxygen in less than a month if the burn is not managed. I don't care about your asset. I don't care about IPs. I care about your cash, actual cash balance. So your immediate focus must be on liquidity as a startup, cash and receivables, and on working capital, your working capital, which is your short-term assets minus your short-term liabilities. If liquidity dries up before your next funding milestone, everything else on the balance sheet becomes like an academic exercise, a textbook exercise, which I don't like and I don't prefer and I don't recommend. That's your signal, Mahmoud, not my signal. So speaking of the gross margin, which is the magic of gross margin. Gross margin is the number that explains why software companies get valued at 10 to 15 times the multiples, 10 to 15 x's the revenue, while manufacturing companies get valued at 1 to 2 times revenue. So if we do the math, $100 in revenue, $15 in COGS, okay, customer support, direct delivery costs, that leaves $85, an 85% gross margin. That's big. Now compare that to a hardware company, same $100 in revenue, maybe $75 in COGS, materials, manufacturing, shipping, so $25 gross profit, a 25% margin. Look at the difference. Look at the difference. For every new customer the hardware company adds, 75 cents of every dollar goes straight back out the door. And for every new customer the software company adds, 85 cents of every dollar stays in the business to fund growth. Now to the core of the case study, Mailchimp. So let me tell you the story of this company because it's the financial architecture antidote to everything fast company who failed got wrong. So the company was founded in 2001, not as a venture-backed startup. It was as a side project inside a web design agency. Two founders who needed an email marketing tool for their own clients. They built one and decided other people might want to use it. Okay? They bootstrapped. Bootstrap means you funded yourself entirely, not a single dollar of venture capital ever. So think about what that constraint forced them to do. Without VC money, they couldn't operate with a high net burn rate. If expenses exceeded revenue, they had to make a choice, cut expenses or find more revenue, or shut down. There was no third option or other choices for them. Okay? Their strategy was grounded in high margin SaaS economics from day one. They hired only when cash flow could sustain it, not when the growth plan assumed they needed someone. When the actual money in the bank, they can hire because there is money to support it. So in 2009, the middle of the worst economic crisis in a generation. You remember the 2008 crisis, right? Mailchimp company made a bold decision. They made a bold decision. They made their product free for email lists with up to 2,000 subscribers. They made it free. No marketing budget required. The product became the marketing engine. If you use Mailchimp, every email you sent to your list included a small sent with Mailchimp. It's like a badge at the bottom. Every recipient became a potential new user. Every campaign was a free advertisement. And what are the results? In 1 year, they grew from 85,000 users to 450,000. It's like 5 times increase. 5 times increase with near zero marketing spend. And look at the equation on your slide. High fixed cost. High fixed cost. The infrastructure was already built, plus near zero marginal cost equals a massive gross margin. Every free user they added cost almost nothing. Every free user who converted to a paid plan was almost entirely incremental profit. You know what? They were very smart. By making the product free at the base level, they created a base. They create a growth engine that required no sales team and no marketing budget. Every customer multiplies by the next customer. And the free tier eliminated CAC almost entirely, which is the customer acquisition cost. And because the product was actually very good, free users converted to paid at high rates because they trust the product. They had tested the product. By 2009, they were profitable. By 2011, they hit break even at scale. If you remember at the beginning, I told you default alive or default dead. Now we start with the default alive. So in 2021, Intuit acquired Mailchimp for $12 billion. You guys know Intuit, right? The QuickBooks company. So Intuit acquired Mailchimp for $12 billion. $12 billion. Imagine the number. The founders owned it all, 100% of $12 billion, because they never diluted a single share of equity to a venture investor. Think about that, okay? Where founders often own less than 10% by the time they reach an exit. At $12 billion, 10% is a great outcome, by the way, but they own 100% of the $12 billion. That's massive transformational outcome. By operating default alive, by ensuring that revenue growth would outpace cost before cash ran out, Mailchimp company never needed outside capital. And because they never needed it, they never gave it away. Okay? So the question is not VC or no VC. The question is, are you building a business that will be alive long enough to reach the outcome you're after as a founder? That's the default alive question. And we will define it precisely in section 6. In section 6. Next question is very easy. Okay? This should be answered in fraction of a second. And it's visible now. Which financial statement is most critical to determine if a startup will survive? People are answering. In the next 6 months. The income statement, the balance sheet, statement of shareholders' equity, or the cash flow statement. You should all vote for the right answer. Amazing. Only one mistake. Someone selected the balance sheet. And that's okay. But I'm sorry, your answer is wrong. The cash flow statement is the correct answer. Okay? Again, is a statement illusion. Don't look at the income statement, don't look at the balance sheet, look at the cash flow statement. And we're going to valuation and equity. And we have our third case study. I believe we're going deeper, deeper, and deeper in the concept of startup finance. Okay, Ibrahim, it's fine. Now you know the correct answer. So, how startups are actually valued? How startups are actually valued? We have three approaches, and let me give you, and again, you should take a screenshot. Okay? Let me give you each one and then tell you which one actually drives early stage startup decision. So, the first approach is comparables. Take a public or private companies in the same space, in the same ecosystem, in the same business model. Identify the revenue multipliers or earning multiples and apply those to your company's metrics. This is how analysts value public companies and late stage private companies, where there is enough financial history to draw a comparison. Approach number 2, DCF or discounted cash flow valuation. You need to project 5 to 7 years of future cash flows. Choose a discount rate that reflects the riskiness of those projections and calculate the present value. And this, it works beautifully for companies with predictable, stable cash flows. Okay? Mature consumer brands, utilities companies, it's essentially useless for early stage startup because the cash flow projection are pure speculation. And approach number 3, the one that actually governs startup valuation, is the VC method. The logic is the following. A VC fund needs to return 3 to 5 times the fund to deliver an adequate return to their own investor. They back calculate, okay, what exit value does this company needs to achieve in 5 to 7 years. They can estimate it, okay? And what does that imply about today's valuation? They compare it to the value it may achieve or need to achieve in 5 to 7 years. And what does that imply about today's valuation? Why? Because valuation today equals expected exit after 5 or 7 years divided by required return multiples. But again, here is what you actually need to understand about early stage valuation. It is far more art than a science. Valuation is an art, not a science. The true valuation is driven by negotiation. I remember I had a valuation course like back in 2013. And the teacher or the instructor used to tell me, Tamer, it all depends. It all depends on what? On negotiation. Negotiation, market momentum, and the VC target ownership percentage. Their percentage in your company, which is typically 15 to 25%. As a venture capital company, they are looking after 15 to 25%. The more options you have, the better the terms you will get, which is another reason why runway matters. More runway means more time to be selective. So if we wanna simplify the valuation math, take one more screenshot, please. Because here we're talking about the pre and post money valuation or the dilution. Did you all take screenshots? I need a yes in the chat box. Okay. So, the dilution math, because this is where founders frequently make an expensive mistake. It's literally an expensive mistake. An investor offers $3 million at a $12 million pre-money valuation. Again, read it again. Okay? An investor offers $3 million at a $12 million pre-money valuation. So pre-money is what the company is worth before the investment, which is right now. Post-money is what it's worth after, which is the pre-money plus the new investment. The 12 plus the 3, which is 15 million. The investor's ownership percentage, 3 million divided by 15 million equals 20%. Look at it. Again, they are looking after 15 to 25% of your company. And now here is the mistake I see constantly. Because founders calculate dilution based on the pre-money. 3 million divided by 12 equals what? 25%. They go into negotiation thinking they are giving up 25%. They agree to the deal. And then when the cap table is drawn up, they have given up 20%. Which sounds bitter, by the way, but they didn't understand the math going in. And the next round will have the same confusion, compounded. So understanding post-money versus pre-money math is not optional for all founders. Every round, every option grant, every convertible note, each one dilutes your ownership. These effects compound on the dilution table. So don't let the dilution table own you. You own the dilution table. Now we have our case study number 3, a company called WeWork. WeWork, a company founded in 2010, backed by SoftBank. You all know SoftBank, right? It's a global investment bank. At its peak in 2019, it was valued at $47 billion, making it the most highly valued startup in the US at the time. And then what happened? S1 filed in preparation for their IPO. Okay? And the entire illusion collapsed. Trust me, the entire illusion collapsed. What happened? The business model, they take long-term commercial real estate leases, 10, 15-year commitment, and sublease the space on a month-to-month basis to startups and freelancers. Okay? So read that again carefully. Long-term fixed liabilities on one side, short-term cancelable flexible revenue on the other side. What was the business model again? They take a long-term commercial real estate, a building, okay, 10 to 15 years commitments. They are committed from 10 to 15 years. That shows on the liability side in our balance sheet. And they sublease it, they sublease the space on a month-to-month basis to startups and freelancers. Risky business. Risky business. So it's a very dangerous financial architecture for a business at any stage. For a company valued at $47 billion, it was catastrophic, a disaster. In 2018, WeWork generated $1.8 billion in revenue, $1.8 billion in revenue. In the same year, They reported a $1.9 billion net loss. Okay? They were losing more than a dollar for every dollar they made. What was their financial architecture, the financial structure? And let me be precise about what went wrong, because we all here to know what went wrong, to learn. Because the lesson here is specific, not generic. On the liability side, I told you, WeWork signed 15-year leases. These are fixed obligations that do not change regardless of occupancy. Whether they had one tenant or 1,000 in one space. The rent was owed. You must pay it. In an economic downturn, which nobody can perfectly predict, those long-term obligations become existential. Okay? On the revenue side, month-to-month sublease, tenants could leave with 30 days notice, 1 month's notice period. So during the COVID-19 pandemic, we all know it, we've been there, which happened less than a year after the IPO attempt. Okay, so they started the pre-IPO and then COVID-19 happened. This is exactly what happened. The revenue disappeared completely. The lease obligations did not. You have a liability, remember. And this is the real estate version of negative unit economics. It's not that WeWork could not generate revenue. No, it's that the fundamental mismatch between the duration of their liabilities and the flexibility of their revenue created a structural fragility that no amount of growth could solve. Okay? You have a long-term liability versus short-term revenue. And this is the WeWork lesson that every founder needs to internalize. The business model flow does not become visible when times are good. It becomes visible when something changes. The time to stress test your model is now, not when the stress arrives. You know, I always say that you cannot predict the future, but you can get ready for it by building. Not very lucky. They lost a lot of money. So let's look at their valuation dilution. Delusion. The multiples gap tells the whole story. Okay, a SaaS or technology company might reasonably be valued at 10 to 15 times annual revenue. We all know that. 10 to 15 times extra revenue. A real estate company is typically valued at 1 to 2 times revenue because margins are very thin, small. Growth is linear and the capital requirements are enormous. So our company, WeWork, was a real estate company. Its core business, leasing space and subleasing it, had like real estate economics. But it marketed itself as a technology-driven platform for the future of work, which is completely wrong. Again, valuation is not permanent. Okay? It's not permanent. It's temporary. And when the S1 reveals the actual numbers, the actual losses, the actual lease obligations, and the actual revenue quality, the consensus collapsed. Peak valuation in January 2019, which was $47 billion. And then when they filed in August 2019, by September 2019, the valuation had dropped to 10 billion. From 47 to 10 billion. By the time of their eventual bankruptcy, a fraction of that happened. So what is the lesson? You can see it here in red. You cannot fake unit economics. You cannot fake unit economics. You can tell a compelling story, a lovely story about the future. You can hire the most brilliant people and build a beautiful brand. But the numbers, the real numbers, the unit economics, the cash flow, they always surface. They will come, around. The only question is whether you surface them yourself proactively and fix them, or whether the market will show them out for you in a very bad way. And it will be a hard lesson for you. We have one more interactive poll question. Please, you need to participate again. Which metric will you audit first tomorrow? This is not a right or wrong question, by the way. Okay? Which of these will actually audit tomorrow? Not this week, tomorrow morning. Pick one, not the most comfortable one, the most necessary one. And then we have our quiz number 4. And that's where I want you to find out the answer. This one, I will give you one, let's say 2 minutes to answer it. You remember? We had the same numbers. Think about the valuation math. An investor offers you $3 million at a $12 million pre-money valuation. What percentage of the company will the investor own after the round closes? Remember, pre-money valuation, post-money valuation. Okay? Do the math. Remember, pre-money valuation, post-money valuation. We calculate what? The percentage of ownership after the post-money valuation, not before. So you take the 12 million pre-money valuation plus 3 million investment equals what? 15 million. And you take the 3 million divided by 15 million. That's your answer. Which is equal to what? Do the math, do the calculation. 20%, guys, not 25%. Okay? And now we go with our final, correct, ya Ahmed Shatta, correct. Our final section, path to profitability. From funding to freedom. Again, from funding to freedom. Please, whatever comments you have, leave it in the Q&A part section. We'll do all the discussion later. We're almost done. So we've covered the metrics, the capital, financial statements, the valuation, and now we bring it all together into the one decision framework that determines the ultimate financial fate of your company. Default alive or default dead. Okay? I love trees. I love trees. So I always make decision trees. Default alive versus default dead. And here is the framework. And it's brutally simple. Take a screenshot again. Take screenshot again. Start with your inputs, net burn and cash balance. Numbers you now know how to calculate precisely. We all know that. And then you compute your runway, the cash divided by net burn. And now ask the question, given your current growth rate, not your projected growth rate, your current growth rate, okay? Not even your dreams, your current growth rate. Will you reach profitability before you run out of cash or not? So if yes, you are default alive. If yes, you are default alive. If no, you are default dead. Again, given your current growth rate, will you reach profitability before you run out of cash or not? Okay? If you will reach profitability before you run out of cash, it means you are default alive. Keep executing the same way. Monitor weekly. Look for opportunities to accelerate. If no, you are default dead. And the decision tree immediately gives you 3 options, not 1. Look at the 3 options. Option 1, reduce the burn rate right now, today, not in 90 days. Option 2, raise new capital, which takes time, so start now. Option 3, pivot your unit economics. Pivot. Change your road, change your way, change your method, change the pricing model, change the customer segment, change the cost structure. Okay? Something structured that closes the gap. It doesn't have to be. Pick whatever. Maybe you start all of them at the same time. So the reason this framework matters is that it turns survival from a feeling into a calculation. Okay? And it gives you options to pick. You don't need to be anxious or concerned about it or about whether your company will make it or not. You need to run the math. The math gives you the answer. And the answer tells you which lever to pull, which one to choose. Yes, we can. And we just spoke about this, right? You know your status at all times, default alive or default dead, okay? In default alive, at your current growth rate and expense structure, your revenue will cross your expense line before cash reaches 0 and you will become profitable. Now we talk about profitability, okay? Additional capital is optional. It accelerates, but it's not required for survival. If you are default dead at your current growth rate and expense structure, cash reaches 0 before revenue covers the cost. Survival requires either a capital injection or a fundamental change to the business model. And the signal here is that if you are default alive, revenue growth is outpacing your burn rate. You control your own destiny. You have investor optionality. You can take capital when and if it makes strategic sense. And if you are default dead, it's a warning sign. Your burn is accelerating faster than revenue. You are entirely at the mercy of investors. Okay, closing on schedule. The choice is binary: raise money or you will die. Okay. And here is the scenario planning. That's like your map. And take one more screenshot. Take one more screenshot. The levers, framework, and scenario planning. When survival is threatened, at risk, you have two levers: cut expenses or grow revenue, right? Cut expenses or grow revenue. And here is the most important operational insight I can give you about these levers. In a cash crisis, do not rely on the revenue lever first. That's the biggest rule, the, the most important one. Okay? In a cash crisis, do not rely on the revenue lever first. You know, revenue growth requires time. It requires CAC, customer acquisition cost. It requires customer decisions to go your way or not. When you have 6 months of runway, you do not have the luxury of time. You cannot wait for a sales cycle. The expense lever is different. You control it entirely. You control your expense. Come on. You can do that. The cuts don't depend on a customer saying yes. Okay? You can decide which expense to cut. They don't require a market to cooperate. They happen the moment you decide to make them. And quick cuts, easy to execute. Immediate runway impact. You may freeze the hiring, cut marketing ad, spend on channels less, or even remove it completely that maybe they are not performing. Audit your SaaS stack and eliminate redundancy. Maybe you negotiate vendor terms. These can add months of runway this week. And if we go deep cuts, it's harder but sometimes necessary. You let people go. You fire people. Layoff, restructuring debt, killing product lines that are not contributing to the core model. And strategic growth, easy to execute, slower to impact. Price increases on your existing base. Upselling current customers, offering annual pre-discounts, right? Let's say for an upfront cash infusion. If you pay me now, you take 10% discount rather than being on a monthly basis. It's like reactivating churned customers. Again, in a cash crisis, lead with quick cuts. Then layer in a strategic growth. The deep cuts and the new revenue plays come after because they take longer and require more certainty than you have. Okay? And now in scenario planning, you need 3 plans. You need 3 plans, not one. The base case, the best case, and the worst case. The base case is your realistic operating plan based on current traction and conservative growth. This is what you run the business on, the current situation. And the best case, if things go better than expected. So you define the triggers that would justify resuming aggressive hiring and expansion. And then the worst case, if a major client or funding does not close, and the plan must be pre-approved. The expense cuts is the worst case must be identified and ready to execute immediately. Clear? So I want to give you the founders or executives 30-day roadmap. 4 weeks, 4 concrete deliverables. Week 1, you need to take a screenshot and commit and tag me on LinkedIn tomorrow, okay? Week 1, the audit, cash balance, gross burn, net burn, runway. This must be a precise number, not a range, not an estimate, a number. You need to build a dashboard that will give you this number every week without effort. On week 2, unit economics. You need to calculate your true CAC, customer acquisition cost, your real LTV, your actual payback period. Then make a decision and put it in writing. When you write it, you commit to it. Are you in scale mode, fix mode, or stop mode? And on week 3, scenario planning. Build your 3 cases. The best, the base, the worst. Define the hiring gates, the specific revenue or runway milestones that must be hit before you add a single headcount. And in week 4, the cap table. Review your current ownership structure. You need to understand the impact of the next dilution, the next fundraise, the next round of investment. You need to know exactly where you will be after the next round closes before you close it. Okay? You should know where you stand. And the final executive mandate, 3 principles. 1, don't delegate understanding. You can delegate execution. You cannot delegate comprehension of your own financial position. Trust me. Number 2, unit economics are gravity. Ignore them and you don't float. You will fall. They are not suggestions, they are the laws of business physics. And rule number 3 is survival is a choice. You can get ready for it. You can get ready for it. Because you know what? Most startups, failures are not acts of, God forbid, issues or name it. Just name it. They are the accumulated result of decisions. Decision to scale before proving unit economics. You remember the fast company. Decision to hire before Runway supports it. To avoid the uncomfortable financial truth until it's too late. So again, survival is a choice. Make it meaningful every week with your eyes wide open. One more quiz. Quiz number 5. I know it's been a long night, but you're all here and you want to learn, and I love having you over. So, a startup is default alive when select the option that best defines the concept we spoke about. Okay? Option A, it has raised the Series A round. Option B, its current growth rate and revenue will reach profitability before running out of cash. Remember, option C, it has positive EBITDA. We never spoke about EBITDA tonight. Its burn rate is under 100K per month. That's irrelevant. MashaAllah. All of you answer correctly. Okay. Which is option B. Okay. That's good. That's like big improvement. To wrap up, tonight session, I know it's been a very long night and this is heavy. And it hits hard. The key takeaways for today. I want to leave you with 5 things I want you to still know 6 months from now. Unit economics dictate survival. Okay? Unit economics dictates it. Thank you, Manard. Thank you. Appreciate it. Cash flow is reality. The income statement is a model of reality. The cash flow statement is the actual reality. Okay? You need to focus on the real statement. Default alive is a choice. Scenario planning and deliberate expense control create what? Optionality. You have options. Okay? Dilution compounds. Each round after the other. Okay? On every round, every option grant, every convertible note, it changes the cap table. And finally, financial literacy is a competitive advantage, not a back office function, not a CFO problem. It's a leadership edge. The founders who understand their numbers, they make better decision faster. Okay? And finally, and finally, I will open the floor for question. I'll take a look at it and take him one by one. But again, you have been asking about the video. You have been asking the recording about the material. It all will be emailed to you along with your certificate of attendance. Okay. Plus the financial terms that we use today. Okay. You will have everything. You will have everything. Use them. Please, please, please use them. Not as a reference document that sits in a folder. No, use them as a working tool that you open every week. Okay? Before you leave this room, I want to ask you one question, and I want you to sit with the honest answer. And I will open it right now. Let's start answering the question. And Bismillah ar-Rahman ar-Rahim. So, can we have the recording? I just said that. Yes, you can. Okay. Yeah, you guys were answering the company. So, Ibrahim Nasser, I believe. He asked about regarding company valuation. I once saw on the Shark Tank program that Ahmed Tariq evaluate a company without the post money. It was a software as service SaaS company. Is it varies from company to company, startup or service company? By the way, it's up to the investor and up to the founder to decide. Okay? It's not a rule. But the calculation says that pre-money valuation plus the new investment equals post-money valuation. Thank you. Local angel syndicate, why speed and flexibility? They are local. Look at the name. They are local. They know the market. Okay? And they are angel. You know what angel? Angel investor. They take the bootstrap, the seed companies and support them. Muhammad Shalabi is asking when we calculate the runway. Every day, Muhammad. We just said that at the end. Every day. Saeed Ahmed Jilani, could you open an investment and portfolio management course soon? We need it very bad. Ahmed, we have the CFSP, which is the Certified Finance and Strategy Professional. Inshallah, will be announced mid of June, and you can start the program on July 1st. But we have plenty of qualification coming your way, inshallah, bi'Iznillah. Do these metrics work with non-startups as well? You tell me. What do you think? Tell me in the chat box. Tell me in the chat box. We have Ahmed. Hello, Dr. Tamer. I have already get the session and need to know if this session suitable for fresh grads or not. Learning never ends. You always learn something new. And honestly, it doesn't matter if you are a fresh grad or not. You can start a business tomorrow, but you should know these fundamentals. Okay? Thank you, everyone. If you guys have more questions, just let me know right now. If not, give me a thumbs up and we will end this session. Thank you, Muhammad. Are we good to go? Inshallah, mashallah, we have so far 1,941. All of them will receive their certificate within 2 days by email, same like the last time with the material. Thank you everyone and have a good night. متشكر جدا ليكم ولحضوركم وان شاء الله تكونوا استمتعتوا وتعلمتوا معانا حاجه مفيده. و as usual, once you get your certificate, post it on LinkedIn, tag me and tag ExecuFinity. Okay, I'm so happy for you. شكرا سهيك، تحياتي. ثانك يو محمود. يلا السلام عليكم and have a good night. السلام عليكم.